This morning we're going to talk about deferred tax. Now there are two, you're probably aware of corporate tax, where what happens is a company pays tax based on the tax rules. So we have to calculate profits based on the tax rules, and then we'll pay over corporate tax, or what accounting refers to as current tax. This is real money. But deferred tax, what it is accounting for the differences between the tax and accounting rules. It actually does not arise in any cash payment, because what you're saying is this is a potential future tax liability resulting from accounting transactions. What do I mean? Well, could you imagine you were going to buy a flat, okay? So you have two flats. Both of them cost exactly the same. This one costs 1,000,000 rubles, and this one costs 1,000,000 rubles, just to keep the figures simple, okay? Flat A, you just pay 1,000,000 rubles and that's it. With flat B, if you buy it for 1,000,000 rubles, you will get tax back of 200,000 rubles. Which flat will you buy, A or B? They're both exactly the same. The second one, of course. Why? Because you're going to get tax back. And that's what deferred tax is trying to do. It's trying to account for the tax consequences of certain decisions. When we make accounting entries, we have to account for the tax consequences of those entries. But most of the tax consequences arise during your normal tax computation, so we don't have any problem. But there are some times when they don't arise in the normal tax computation, so there's a difference between tax and accounting rules, and that gives rise to deferred tax.
And the second one is for GAAP or national standards.
Yes.
You can use different methods of inventory counting.
Yeah, but you would be mad. Right? Let's say you have a Russian company. You don't have Russian companies who do local Russian and IFRS, do you?
Some of Russian companies should provide, must provide accounting reporting in IFRS.
Yeah, but then they wouldn't do Russian, they wouldn't do local accounting.
They would do at the same time. They will do both.
Why?
And then
Why?
the third is tax accounting.
You got tax accounting because that's not financial reporting. Tax accounting, everybody does, for tax rules. Yes, everybody has to do it. That has nothing to do with financial reporting. We are dealing here with financial reporting, which is giving information to investors outside the company, right? That's either under Russian GAAP, IFRS, or US GAAP. But obviously in CFA we're not touching Russian GAAP, but it's not tax reporting, okay? Forget tax reporting, first of all, right? I would be very surprised unless, I can't think of situations where you would have a company, because IFRS is it for all Russian entities or just for public companies?
For public.
For public. So if you're a private, and banks, yeah? Or banks, whether they're public or private, yeah? Okay. Now, if you're maybe a private subsidiary and you have a holding company who's a public group, maybe there's some stupid situation like that the subsidiary might do accounts under Russian accounting, but then they have to do a reporting package to be included in the holding company's financial statements under IFRS. It would be very rare for, I presume under Russian accounting, you're at least allowed FIFO and average cost. I don't know if I cannot tell you if you're allowed LIFO, right? But you would be mad to do LIFO for Russian accounting and convert to FIFO for IFRS. Just mad. You would be creating so much work for nothing, right? That most companies, once they pick a method for allocating costs for units of production, they will use that for everything. The effect as this pretends to make it, okay? And as a rule, you'll get caught anyway when you go to opening inventory. So I would be shocked if you could show me a Russian manufacturing company who uses one method of allocation for Russian GAAP and a different one for IFRS. Maybe there is one, okay, but it would be surprising. I will explain it as we go along. Assume purchases and sales occurred as follows. We have our opening inventory. Straightforward. Then on the 7th of January, we bought 3 units at $3 a unit. That's obviously $9 they spent. Then on the 12th, they made a sale of 4 units. We don't care about the sales price because we're just doing this for the purposes of costing and inventory valuation. Then on the 19th, we had a purchase of 5 units. Prices are going up rather dramatically at $5 a unit. As you can see, this would be a very dangerous industry to be in. And then on the 29th, you have a sale of 3 units. Recalculate COGS is what you will see for cost of goods sold. Under the FIFO and